So it's another great time we meet for this session of advanced financial reporting. We are going to look at consolidated cash flow statements. That is according to International Accounting Standard 7. So this is well catered for, even from the other parts of the CPA. That is even from financial accounting, from financial reporting, and now what I'm going to do is based on the advanced financial reporting. That is, you are aware of that. So when we talk about cash flow statements, remember that when presenting your cash flow statements, you can either use full method, you can either use direct method or indirect method. So either direct or indirect. Remember the cash flow statements is presented based on 3 activities. That is the operating activities, the investing activities, and finally the financing activities. So we present cash flow statements based on the 3 activities: operating, investing, and financing. For the operating activities, what are you going to deal with under operating activities? Mostly those operations which are revenue generating in nature. So the one which are done on a daily basis in the business. So the core activities of the business. So under operating activities, we talk about the day-to-day operations. Under investing, it's all about what the entity is getting from mostly the disposal of long-term assets. Then for financing, it's all about what changes the composition of the entity. So it can be in terms of equity or debt. So that is the 3 areas we'll be looking at when presenting cash flow statements using the 2 methods. So the direct method or indirect method. So if we do a question, it can be better for us to address this aspect of cash flow statements. But if you need more of an in-depth introduction, there's a video which I did for the introduction. But the introduction is just the same thing I've mentioned. It's only that now what you need to understand is what about the format. But again, doing a question direct, I think it will talk about the format more better than even drawing the format, then doing the question. But if you need the format first, then we do the question. You look at there's a video I will share. So at the same time, what I will be doing here will address your questions, maybe, if you will be having any in terms of cash flow statements. So the question of today is from December 2017, question 3. December 2017, question 3. From December 2017, question 3. So I hope that everybody, you have a link to the past papers. So in just a few minutes, you can open this question. Advanced Financial Reporting, November 2017. November 2017, question 3. So, and at the same time, what you need to know, the main concern in advanced financial reporting, to be more specific in terms of cash flow statements, is that there might be acquisition or disposal of subsidiaries which will be incorporated in that cash flow statement. So you will find that there's a subsidiary which was acquired or disposed. You know that a subsidiary is a company acquired by the parent, and the percentage of acquisition lies between 51% to 100%. That is not new to you because you did consolidation in intermediate level. You know what are subsidiaries, and what are joint ventures, and what are associates. So, but now here you will find that there's a subsidiary acquired or disposed. How do you incorporate it in the presentation of your cash flow statement? How will you be incorporating it in the presentation of your cash flow statement? So you need to know how you incorporate it in the presentation of cash flow statements. So here they were saying that it's question 3B, following the group statement of a comprehensive income and the group statement of a financial position of Maneno Group of Companies for the financial year ended 31st October 2016, 31st October 2017. So you are given an income statement, statement of comprehensive income. Then we have statement of financial position, statement of financial position. Then there's an additional information whereby you are told that during the year that 1st October 2017, depreciation of 240 was charged in relation to property, plant, and equipment. And number two, an item of property with a carrying value of 885 was disposed of during the year ended at 1st October 2017 for 750 million in cash. The loss on disposal is part of the cost of sales. Number three, on 1st August 2017, the group disposed of an 80% owned subsidiary for shillings 1,170 in cash. The subsidiary had the foreign net assets as at the date of disposal. So you can see at number three, there was a disposal of 80% on the subsidiary. So this subsidiary, obviously, it must have been acquired some times back because it was disposed on August. We cannot dispose something we don't have, what we don't own. So they said that on 1st August 2017, the group disposed of an 80% owned subsidiary. So this subsidiary was acquired when? That is why you can see there's a sentence down there in note 3, whereby they are saying that the subsidiary had been acquired on 1st November 2012 for a cash payment of 660 when its net assets had a fair value of 675 and then non-controlling interest had a fair value of 150. Additional information number 4. They said that additional property, plant, and equipment was acquired by way of a lease amounting to 900 during the year ended at 1st October 2017. Number 5, dividends paid by the holding company. Dividends paid by the holding company during the year ended 31st October 2017 amounted to 120. Number 6, land was revalued upwards by the holding company by 60 million during the year ended at 1st October 2017. Required the group statement of cash flow in accordance with the I-7 statement of cash flow. So here you just present your cash flow statements. So the examiner is not specific which method to use, either direct or indirect can be used. So I will start with indirect. And the examiner is not open which method to use. Go for the indirect. It's a bit easier and it will give you a lot of marks in your operating part, even before you move to other parts of the cash flow statements, that is investing and financing. So you look at this, how we are supposed to present it. So November, that is November 2017. Question 3, November 2017, question 3. So on this scenario, you talk about, I think you have the soft copy of the same. So it's all about Maneno Group. So it's a group statement of cash flow. Group statements of cash flows. Group statements of cash flows. So that is for the year ended. For the year at 1st October 2017. So remember that it is in millions and millions here. So we start from operating activities. We start from operating activities. So here, starting from operating activities, we always start from profit before tax. Profit before tax. So you go to your income statement. Your profit before tax is 699 from your income. So from your income statement, we have 699. So then we adjust this profit. This profit must be adjusted. So we adjust this profit. So this profit must be adjusted. So we adjust this profit against what? We adjust the profit against what? Against non-cash flow items, which were adjusted in order to arrive at this. So remember that in arriving at the profit before tax, there is something which happened. Because we started from revenue. We deducted the cost of sales. Of which we added some incomes. Then some expenses were deducted. So here, there's some incomes which were added, which were not supposed to be added. And there's some expenses which were subtracted, which were not supposed to be subtracted. Because the one which were not supposed to be added and subtracted, these are incomes and expenses respectively. They are just non-cash flow items. So non-cash flow items. So we have around 5 which we always check before we go to the others, which are a bit direct. So we always check for depreciation. I said impairment, amortization. We just write them here direct. Let me stop repeating myself. So the first one is just depreciation. Impairment. We have amortization. We have loss on disposal. And we check for the gain on disposal. These are some of the non-cash flow items which might not be direct. Some of them might be in the additional information. So if you go to your question, the November 2017 question 3 for the guys joining now. So in that question, additional information number 1, you are told that during the year ended at 1st October 2017, there was a depreciation of 240, which was charged in relation to property, plant, and equipment. These are depreciation. There's a depreciation of 200 and what? 240. There's a depreciation of 240. So remember that this one is an expense which was deducted. So we add back. Then for impairment, now this one might not be direct because impairment arises due to what? Where does impairment arise from? So you have to check if you have goodwill in your non-current assets first for you even to go ahead and look for impairment. to analyze. Remember that here we do analysis. We don't just even compute for goodwill. You will be given the goodwill. So if you are given goodwill, is when now you do analysis to determine what? Impairment. So in your non-current assets, is there goodwill? Yes, there's goodwill. So remember that we do analysis because here in the statement of financial position, you are given the statement of financial position as at 31st October 2017, as at 31st October 2016. So we compare from 2016 to 2017. So in 2016, our goodwill was 390. At the end, 2017, it was 255. So here we can conclude that there is impairment. But now this is not the final conclusion, because in the advanced, now this one in short, there's an aspect of subsidiary, which was, like now in this question, there's a subsidiary disposed. So we need to know the goodwill of this subsidiary, and we determine impairment. Then I'd just here, under this analysis, then now we do a final conclusion that there is impairment. So let's determine the goodwill of the subsidiary disposed. Remember, there was a subsidiary which was disposed in this question, according to additional information number 3. That subsidiary was disposed in August 2017, of which, when we are doing goodwill, we don't do as at the time of disposal, but the time it was acquired. That is why immediately after that, note 3, there is a paragraph down there, whereby they were saying that the subsidiary had been acquired on 1st November 2012 for a cash payment of 660, when the net assets had a fair value of 675. And the non-controlling. So what I'm supposed to do now here is all about analysis of the goodwill of the subsidiary disposed. So goodwill, you can either use full method. Do you remember from the financial reporting? You can either use full method or a partial when doing goodwill. Full method or a partial method. Remember that you can use full method if the NCI is stated at fair value. The non-controlling interest is stated at its fair value. You know that the NCI is all about the percentage unacquired in the subsidiary. Like now here, it was an 80% controlled subsidiary. So 20% is for minority shareholders. The one with the parent doesn't control. So for you to use full method in computation of goodwill of that subsidiary as at the time of acquisition of that subsidiary. So for you to use full method, the NCI must be stated at its fair value. That is what you need to know. So already we were provided with the fair value of the NCI. We are already provided with that. So how do you determine goodwill? Purchase consideration minus what? Minus net assets. So the purchase consideration . So the purchase consideration here, when the subsidiary had been acquired on 1st November 2012 at a cash payment of 660, the fair value of NCI, now you put it on the other column, and this is 150. So you raise what? You raise the net assets, share of net assets acquired. Share of net assets. So net assets, the total value given there is when its net asset had a fair value of 675. So you share 80% and the 20%. So remember that the first column is for the parent, and this one is for the NCI. So what you do here, you share the 600 and what? 675. So 80% times 675. This is 540. Then 20% times 675. This is 135. So 660 minus 540, 120. Then you have 15. So this is 135. So this is goodwill. So you have total goodwill of 135. So this is a goodwill of a subsidiary which was disposed. But this, as at the time it was acquired, its goodwill was 135. Then later it was disposed. Now I can be able to conclude if there is a impairment, because balance brought down as at 2016. Our goodwill was the one given in the statement of financial position, 390. So now I minus the disposal. The goodwill on the subsidiary which was disposed, the 135. So up to this point I have, this is 8, this is 5, this is 2. I will skip one line here, skip obvious one line for your balancing figure, then write balance carry down as at 2017. Balance carry down. So you can see their balance carry down is 255. So there's no difference here. If it could have reduced directly up to 225, that is when I could have said that it has been impaired. So here we don't have impairment. No impairment. You say it's 0. It never reduced. So there's no impairment. That is how you check for impairment. So if amortization, other intangible assets are the one which are amortized and we don't have them. We don't have any other intangible assets here. And just say XX. Then loss on disposal or gain on disposal. So for the gain or loss on disposal, we need to check if there's any asset which was disposed. In note 2, there's an item of plant, which with a carrying value of 885 was disposed of during the year for 750. So meaning that it was disposed at a loss of, it was having a carrying amount of 885. It was disposed at 750. It was disposed at a loss of 135. Then there is a gain on sale of subsidiary. Gain on disposal, stock sale of subsidiary. That is from the income statement. Gain on disposal, stock sale. Disposal is the same as sale of subsidiary. That is from the income statement. Is 120. But that one was added, we subtract. Now, other items which are in the income statement, which are supposed to be adjusted against the profit before tax, are this one. You go back to your income statement. So already we are in the income statement because I've started picking some items from the income statement. So if you go back again to the income statement, the one provided in the question, go to the point of profit before tax. Profit before tax. Then what you do, you just check the items which have been adjusted above the profit before tax. Above the profit before tax. So the items which are there. So which are the ones which will appear here in those items above the profit before tax? So other than revenue, cost of sales other than revenue, cost of sales, and what? Revenue other than revenue, cost of sales, and operating expenses. Remember that operating expenses are which expenses? Admin and distribution expenses. So other than this, another item above the profit before tax, they are non-operating. They're supposed to be adjusted against that profit. Other than revenue, cost of sales, admin or distribution expenses. Remember, admin and distribution is what we call operating expense. So other than the 4 items, the others we adjust. So like now, which items are there? I have already adjusted the gain on sale of subsidiary. So the next one, other than the 4 I have mentioned, the other one is share of profit after tax in associate. Share of profit after tax in associate. Share of profit after tax in associate, which is 144. That was added. Then we have finance cost. We have the finance cost. Finance cost is 452 was deducted, we add. So up to that point, what we have is the cash flow before working capital before changes in working capital. Cash flow. So the cash flow before what? Changes in working capital. Changes in working capital. WC, changes in working capital. So 699 plus 240 plus 135 minus 120 minus 144 plus 450. This is 1260. And then now we talk about working capital. I will be looking at current assets and current liabilities. Current assets and current liabilities. So changes in working capital. So the changes in working capital. So we check out current assets and current liabilities. So starting with current assets, we have inventory. So we check increase or decrease. So we shall say in inventory, then I will be able to conclude here if it's increase or decrease. In inventory. So is it an increase or a decrease? So I compare the two periods. So we have 3090. That is from 2016. But now remember here, you have to incorporate your disposal. So when they disposed their subsidiary, that is not the 3, it was having an inventory of 90. So disposal you minus. But now you compare with the balance carried down. That is 2017, 39. So you can see it increased. This is 3,000 to 39. So here you say increase. 900. So now from here going down, remember this one I was adjusting this profit. But now from here, henceforth, For us to know that we are deducting or adding is all about the interpretation we will do in terms of cash inflows or outflows. Like now, when your inventory increases, this is an asset which is increasing, meaning that you purchased the stock. What happens to cash? You paid money. So this one you minus. So there's cash out because you purchased the stock. So from here henceforth, we talk about cash inflows or outflows. That is how I will be able to know that I'm adding or subtracting. The next thing is all about the receivable. So receivable, that is debtors, it's that 120 minus the one in disposal, 135. Then at the end again is that 120. So you can see it's a decrease or an increase. Increase by this 135. So again, this one you minus. Because once your data increases, it means that you are giving your debtors money. Increase in debtors balances. There's money out. Then in that current assets, there's financial asset at fair value and the cash and bank balances. Those are cash and cash equivalent items. We don't have to use them at this point. We go to the current liabilities. I check only the payables. The other items will be applied elsewhere. So the payables, is there increase or decrease? For payables. So in payables, under current liabilities, from the initial period 2017, it was, that is in 2016, it was 1785. I deduct the payables, which is in note 3, on the disposed. Subsidiary is 540. Then I compare with balance carried down of 2955. So meaning that there's an increase here of which figure? $1,785 minus 540 minus 2955. That is 1710. So when your liability increases, these are an increase in creditors. Creditors are the people who sells to you on a credit basis. Meaning that when they are increasing, still they are selling to you, and you have not paid. So it's like you are acquiring more liabilities. You are acquiring on your side. You are acquiring debts. So there's nothing you have paid. So when the liabilities will be going down, is when I could have said that I have paid the liabilities. That is when I could have deducted on the decrease. But now since it's an increase in liabilities, and it's for our company, it means that we are getting debts. We have not paid. We have not paid. So we add. So up to that point, we have the cash generated from operations. Cash generated from operations. So if I take 1260, I minus 900, I minus 135, I add 1710, I will get 1935. And what I will deduct here is tax paid. So now for the tax paid, I have to do a working. So these are working. So you will do it elsewhere. Remember, you have to skip around a page because there is 2 activities remaining. I will be talking about investing and financing. So in your workings, maybe you do after skipping around a page. Well, this statement continues with the investing and financing activities. So working, here we talk about tax. So we consider current tax and a deferred tax. Or we consider current tax and what? deferred tax. So I will start with balance brought down, which is the balances as at 2016. I will be checking current taxes from current liability, deferred tax, non-current liability. So we have 915 deferred. Or I start with current. Current 2016, 63 plus 915. That is 978. But this is current deferred tax, both for 20 as at the end of 2016. Then here we raise the tax on the subsidiary which was disposed, the current tax for the subsidiary which was disposed. So it's 15. So if it's disposed, remember we minus. So at that point we have what? 963. But before I say 963, remember that I need to add the tax which was paid for the year, the income tax, the one from P&L, income statement. That is the one I had not incorporated, the 144. So plus 144. This is 1107. And now we skip one line, then we say balance carry down. Again, we take current tax plus deferred tax for 2017. 84 plus 1020. 84 plus 1020. This is 1104. So here we have, but this was 1107. So you can see they were supposed to pay a tax of 1107, but at the end they are told to pay 1104. So meaning that this a tax paid of 3 million. That is what we deduct here. So here we have cash flow from operating activities. This is 1932. So we are done with the first part of the cash flow statement. That is operating activities. Now I can continue with investing, then we do financing. Any questions so far? So I think so I'll continue with investing activities. So now for investing, it's not difficult investing because what I will be checking is just around 4 items. The first thing, I will check if we disposed an asset, what we received, cash received. Then if we disposed, and mostly for disposal, we do analysis of the property, plant, and equipment for the disposal of assets, so that we determine what we paid on the disposal of assets. Then after that, we check investment income dividend received from either an associate or a joint venture. So it can be from associate or joint venture. So, and this one will be guided with the investment given in the non-current assets. So you will find they say investment in associate or joint venture. Based on that, you check for the dividend received. Then finally, right now here we have a subsidiary which was disposed. We have to check what Maneno received from that disposal. That's all, nothing else. So if we go direct to the additional information number 2, there's a property which was disposed for 750. So cash received on disposal of property. So they received what? 750. Then I said now for the cash paid to acquire property, to acquire an asset in short, like now property, we have to do the PP, property, plant and equipment analysis. So we'll come here and do a working on the property, plant and equipment. So I will do a working on PPE. So I will start with balance brought down. So from the statement of financial position, we have 13,500. But this is our net book value. So now I would check anything affecting property, plant, and equipment. Remember, this is tangible fixed. These are tangible fixed assets. These are about tangible fixed assets, which have been aggregated. So anything which can be affecting a tangible asset, a tangible fixed asset. Because PP is just not one asset, it's just all the tangible fixed assets which have been aggregated. So if we go to additional information, number 1 is depreciation. See, depreciation is a fixed asset which is depreciated 240. Number 2 is property which was disposed. But I need what? Its net book value. That is why you were told the carrying amount was 885. Additional information number 3, under the subsidiary disposed. Under the subsidiary disposed, there is a PPE, property, plant, and equipment of 2025. Remember disposal minus. Under note 4, there is a property which was acquired by way of risk. PPE acquired by way of risk. So its net book value was, so it was 900. They said 900. So that one you add. Then note 6, there is rand revalued. Rand revalued at 60. So up to that point, all of this affects PPE according to this question. So 13,500 plus 240 plus or minus. This one is minus depreciation. Depreciation reduces the value of the asset. Minus 240 minus 885 minus 2025 plus 900 plus 60. So this is 11,310. Now you compare with the balance carried down. Balance carried down as of 2017, property is 18,000. So this increased. So when it increases, this acquisition which was done. They did an acquisition. If it reduced, that is when I could have said they did a disposal. So they did an acquisition of an asset worth 66.90. So they paid that 66.90. That is what I will record here. Then I said if there's investment income, we could have recorded, but it's not there. Because it could have even appeared again in the operating activities. Under the operating activities, we could have deducted the investment income. Then here we add. So the next thing I will check is the dividend received. From where? Here we have dividend received from associate. Because we have investment in associate. Because we have the investment in associate. You can see this investment in associate. It's an investment in associate in the non-current assets. So the balance brought down being investment in associate 420. Then if you check in the income statement, remember the parent had investment in associate first. Before we go to the income statement, we have 420 from the initial, from 2016. So this investment in associate is 420. Then there's an income the parent received from this associate, the one they call share of profit after tax from the income statement. Share of profit after tax in associate. So the parent had received already 144. So as income. So meaning that this investment, for now, it stands at 564. So balance carried down is the investment in associate, 510. Why did it reduce from 564 to 510? Because they received dividends. The parent again received dividends from the associate. Dividend received of 54. Then finally now, due to the subsidiary which was disposed, this cash received. Cash received on subsidiary disposed. On subsidiary disposed, net of cash disposed. So in note 3, when they disposed this subsidiary, they received 1170. That is what they said. On 1st August 2017, the group disposed of an 80% owned subsidiary for 1170. 1170. So remember that when the subsidiary was disposed, there's a cash which is part of the net assets, which it was disposed with. Because if you check in on the 3, we have assets like PPE, inventory, receivable, cash, and bank balance. So we need that cash. So when it was disposed, there's a cash and bank balance of 105, which it was disposed with. So even if we received this, there's money which went out of 105. That is why I said net of cash disposed. Net of cash disposed. So we net that money which went out based on the disposal. So 1170 minus 105. So this is 1065. So up to this point, we have cash flow from what? Cash flow from investing activities. So 750 minus 6690 plus 54 plus 1065. So this is a cash outflow of 4821. So it can be a negative. It's not that when you get a negative, you say you are wrong. No, it can be a negative. The answer can be a negative. We call it a cash outflow. A cash flow can be inflow or outflow. So now we finalize with financing activities. So remember that for the financing activities, we check mostly on the two parts, equity and liabilities. So if I start with the equity part and I move to liabilities, I check what I have not dealt with. I will be able to conclude my financing. So for equity, I start with ordinary share capital with these are working here. Ordinary share capital and the share premium are combined. So for you to check if there's issue of shares or redemption. So the balance brought down for the ordinary share capital, you combine with share premium. As at 2016, it's 45, and the other one was dash, so plus 0, so 4,500. So if there was any issue of shares, not even issue of shares, if there's any bonus issue, because bonus issue is shares issued at no consideration, stroke right issue, but it would affect here. But there's nothing. If there's even shares issued as consideration, you include them here. So this is 45. Then balance carried down. Ordinary share capital and share premium, 6,000 plus 969. So there's an increase, meaning that they received the cash due to issue of shares. So cash received on issue of shares. That is what took place. 69. That is why the value increased at the end. They received some money. So 6,900 minus 45. So this is 2,400. Sorry for the disruption. There was an emergency call on my end. But mnaelewa chenye nafanya, si ndio? Are you?
Yes.
So tuko hapa sasa. So hii mmerekodi hapa. Cash received. So the cash received on issue of shares. So what if it could have reduced, let's say to 5,000, not 5,000, 4,000 at the end. But the difference could have been 500. So you could have said that they paid this on the redemption of shares. So it could have been cash paid on the redemption of shares. On redemption of shares, so that you subtract. After ordinary share capital and share premium, we go to the others. Revaluation reserve, yeah, achana nayo. So retained profit, it assists us to get the dividends paid by parent, which we already have. Dividend paid by parent company. Remember, parent company is same as holding company. Already we have the dividends paid by the holding company. That is according to note 6, which was 120. So the only working I will do is the dividends paid to NCI. Dividends paid to NCI. So again, I have to go to my non-controlling interest. I do a working. So that is the next item, because after retained profit, the shareholders fund, which is the total of the equity, then the shareholders fund attributable to the non-controlling interest, balance brought down being 525. 525. Then you go to your income statement, there's a profit attributable to NCI, you add the last item from the income statement, profit attributable to NCI, 75. Then here there's 2 items we include. Goodwill, share of goodwill to NCI. Share of goodwill to NCI on subsidiary disposed. But this one can only be applicable if full method was used. So we used the full method. The goodwill of the NCI was on the other column. Remember, there was first column for parent and the other column for NCI. When we did the goodwill of the subsidiary which was disposed, we got 15. You remember it was 15? If you go to that working for the goodwill of the subsidiary disposed, that's at the time it was acquired. When we were checking for impairment, we did that goodwill. Of the NCI, the second column, it was 15. For the parent, it was 120. 15. Then the next thing you check is all about the share of NCI on net assets. On net assets of disposed subsidiary. Remember, in that note 3, the net assets were totaling to 1,200 of the disposed subsidiary. The one given direct there. So there's 20%, which is supposed to be attributable to the NCI. So this is 24. 24 to 40. To 40, yeah? So this one we deduct. Because you deduct because it's a disposal. If it's an acquisition, you add. That is the only difference between disposal and acquisition. So this is 345. So the balance carried down for the NCI was, if you check in the equity, shareholders fund attributable to the non-controlling interest, we have 225. So there's a reduction of 120 because there's a dividends. There's dividends. That is what I was looking. The dividends of 120. So we are done with the equity part. We are done with the equity. We go to the liabilities. The first liability is bank loan. We check if there's any loan they acquired or they paid any loan. So what I can see there, the loan was 3,000 as at 2016. If I minus the disposal, so obvious there will be acquisition of loan, because acquisition of loan, because as at 2016, we have a loan of 3,000. I minus the loan, which is there in note 3, based on the subsidiary which was disposed. There is 600. So far we have 2,400. If I compare with my balance carried down of the bank loan, it's 42. So meaning that at the end it's more. That is one shows they acquired another loan of 1,800. There's money in. After bank loan, we have obligations under finance lease. But obligation under finance lease is both in non-current liability and current. So what we do, we aggregate. So we do our working again. So we do our working for that. So we do our working for that. So obligation under finance lease. So we are trying to check if they paid for the lease or they continued then using the lease without paying. So obligation under finance lease. So if I combine, because I can see they spot in the short term and long term, so I will be combining. So as of 2016, the one from non-current liabilities is 135, and the one from the current liability as of 2016 is 30. That one gives me 165. It's 30, yes. Then in the additional information, there is something to add. That is additional information number 4. There's a property, plant, and equipment which was acquired by lease. Add PPA acquired by lease, the 900. So up to this point, we have 1065. Compare with your balance carried down. So the balance carried down here is 630 plus what? 45. Under non-current liability and current for 2017. So this is 675. 675. So there's a reduction. There's a reduction. Meaning that they did a lease repayment. They did a lease repayment. They did a lease repayment of 390. That is why the value reduced. So lease repayment of 390. Finally, what's remaining? Because already for deferred tax, we combined with current tax. That is how we arrived at tax paid. If we go to the current liabilities, we have payable. Payable was part of working capital. So the only thing we have there is interest. So we need to check interest paid. There's accrued interest. So interest, as at the start of the year, that is, as at 2016, they were supposed to pay an interest of 27. plus the one from the income statement. The finance cost is an interest of 450. So meaning that by this time they are supposed to pay an interest of 27 plus 450, 477. But at the end, as at 2017, they are supposed to pay just 21. So meaning that they have paid what? They have already paid an interest of 456. 456. So up to this point, I can be able to get cash flow from financing activities. Cash flow from financing. So the cash flow from financing activities, 2400 minus 120 minus 120 plus 1800 minus 390 minus 456. So we have 3114. So this is C. Then here we have net cash flows. So net cash flow, now you take A plus B plus C. A plus B plus C. So if I take 1932 minus 4821 plus 3114, I will be able to get 225. Then I will come here and add cash and cash equivalent. Balance brought down. So that at the end, we get a cash and cash equivalent balance carried down. So cash and cash equivalent, we do our working so that we combine all of them, the one which are available there. So cash and cash equivalent, we just say 2017, 2016. You know the items of the cash and cash equivalent, the components. Cash at bank, cash in hand, short-term investment like financial asset at fair value, and bank overdraft. So under current asset, we have two items of cash and cash equivalent, which is financial asset at fair value, which is a short-term investment, and we have cash and the bank balances. So our cash and bank balances. So we have 135 and we have 30. We have 510, 390. Then we raise overdraft. If there was bank overdraft, was there bank overdraft? In the current liabilities, there's no bank overdraft. I could have deducted. So 30 plus 390. So this is 420. And this is 645. So this is the balance carried down. This is brought down. So what I will do, if I put my balance brought down here, as at the start of the year, I add to the net cash flow, which was during the year, would I be able to get 645 at the end? Yes. So it's all about you have reconciled the cash at the start, the opening balance, that is, and the closing balance. That is, you have reconciled the opening cash and the closing based on the transactions which took place during the year, from the start of 2017 to the end. That is the end of this question using the indirect method. You have the one for, do you have any question that is, before I move to direct? We have some minutes remaining. Yes. Any question? Question. Meaning you are okay if there is no any question. You are doing well. Everything is okay. So if it was direct method, remember direct method is just only first part I will be doing. So I will just be doing operating activities. The others remains the same. So for the operating, you start with cash received from customers. When you talk about cash paid to suppliers, then you talk about cash paid to employees. So that we get cash flow from operating, cash generated from operations. Cash generated from operations, then you deduct what? Tax paid. So that we get the cash flow from operating activities. So for the first one, cash received from customers, working number one, we do the debtors account. Balance brought down 2016, balance carried down 2017. So 2016, but debtors, you go to the current asset, we have at 120, we have at 120 for 2017. What can increase your debtors balances? Issue, not issue. That is sales, or the revenue. Because revenue is due to sales. So the one from the income statement, the 3075. You assume that when they made that 3075, it was due to sales which was on credit. You assume, assume on credit. What can reduce your debtors balances? But we said bad debts written off. Bad debt written off. Discounts around. All of these are not present. And the only thing I will include here is trade receivables on the subsidiary disposed. So subsidiary disposed. There's a subsidiary that was disposed. So we deduct the debtors on that subsidiary disposed of 135. So the balancing figure is what the customers, is what you received from the customers. So that 120 minus 3075. So this is 6195. 6195 minus that 120 minus 135. So you have 2940 cash received. Then we go to the cash paid to what? To suppliers. The first thing we do, we determine credit purchases. Then we do the payables account. Something which cannot take even 10 minutes. So the first thing, another word, determine credit purchases. So we said, how do you determine the credit purchases? How do you determine credit purchases? So we remember that for you to say cost of sales, we always say cost of sales is equals to opening stock plus purchases minus closing stock. Eh? So we need purchases. We make it the subject of the formula. If we leave it on the other side, we will say cost of sales minus opening stock plus closing stock. So cost of sales is all about what? In this question, the cost of sales was 1470. So cost of sales is obviously inclusive of some expenses which are supposed to be deducted. Expenses like depreciation and loss on disposal are obviously included here. This one, you know it from published, that this depreciation and loss on disposal are obviously included under the cost of sales, unless or otherwise told. So there was a we already did we already did the two. So we are provided with depreciation of 240, which is obviously included here. We minus. Another thing I have said we minus here is the loss on disposal of 135. Remember, there is a loss on disposal based on note 2. The carrying amount of the property which was disposed is 885, of which the property was sold at 750 at the loss of 135. 240 is depreciation, which is given in note 1. Depreciation and loss on disposal are obviously included under the cost of sales. You deduct the two. So opening stock is the stock inventory as at 2016, 3090. I will deduct 90, which is the inventory for the subsidiary which was disposed. This is the subsidiary which was disposed subsidiary. Then finally, I will add the closing stock, inventory as at 2017 of 39. So my answer here would be, so if I do this, 1470 minus 240 minus 135 minus 3090 minus 90 plus 3900. So I would be getting here 1995. That is the answer. 1995. So this is the answer. So that now we do the payables account. So the balance brought down here is the payables, the creditors. The balance brought down is 1785. Balance carried down being 2955. Was 2016, 2017. And what increases your creditors' balances? Credit purchases. And that is what I have determined here, 1995. What can reduce your creditors' balances? Discount. If you received a discount received, but it was not there. Then what can reduce again this? The payable, the subsidiary disposed. So this subsidiary disposed, it was having a payable, that is not a 3, 540. So that cash paid here would be cash paid. So 1785 plus 1995. This is 3780. 3780 minus 540 and the 2955. So this one is 285. Then now, cash paid to employees. So for this one, I would be considering my operating expenses. So the operating expenses we have is so distribution is so the distribution costs 240. Admin is 480. So the total of the two, before I do any adjustment,
$720.
so that is what you are saying. But I think you are following what I'm doing and you are okay with it. But cash flow was not there as sitting. Eh? Are you aware of that? Hmm? Cash flow was not present in the receipt. So anyway, this total is 720. So that is it, 720. So 2940 minus 285 minus 720. We have 1935. See, our tax, we determined this initially. It was 13, it was 3. When we did the first method, the indirect, see, tax was 3. So meaning that this is 1932. Is it not the same as the one we did in indirect method? See, they're the same. So we got this. Hmm? When we did indirect method, our operating activities, it was 1932. I'm asking you guys.
Yes.
NB, investing and financing are the same in both methods. Investing and financing activities are the same in both methods. But now you don't have to write this in an exam. So if you were to use a direct method, so after doing the operating this way, investing you continue the way we did initially in the indirect method. And the financing you do the same, the way we did in the indirect method. So that is it for this question using both methods. And that is it for the today's session. So let's meet next so that I will be doing another question, maybe on the acquisition of the subsidiary. Have a good day if there's no question.
Thank you.
Thank you. Bye.